Hi, welcome to the latest edition in the Glio webcast series. My name's Sean Stevens, and today I'm joined by Frank Graywit of DWS and Alan Armstrong, the CEO of Williams. So let's hand over to Frank and Alan for what will undoubtedly be fascinating insights into the latest developments in the sector.
My name is Frank Graywit with DWS. I am pleased that I have the opportunity to speak with Alan Armstrong of Williams Companies, and a big thank you to Glio for hosting this interview. So thanks again, Alan. Could you give us a quick overview of your business, including your assets and segments, and how those integrate within Williams?
Sure. Well, Frank, thank you, and look forward to the discussion today, and thanks to Glio for hosting this as well. So from a Williams perspective, we handle about a third of the nation's natural gas here in the U.S., and that is through our long-haul transmission lines, our gathering systems that operate across the U.S., and we distinctly have the nation's largest pipeline, the Transco system, which I'll talk a little about later, but certainly a distinct system in that it's by far the nation's largest from an earnings standpoint, and it's also the fastest growing, which is a pretty hard combination to have. But in terms of the segments that we operate in, we have the long-haul business, which is our gas transmission and our deep water systems. That's about 45% of our business. Our gathering and processing, which is very large-scale gathering and processing, and in most of the basins we operate, we're the largest gathering operator. So that's another 45% of our business is our gathering and processing, and that is mostly focused in natural gas basins here in the U.S. And then finally, we have a working interest in some production in the Wamsutter Basin, which is in Wyoming, where we have the gathering and the NGL takeaways and the gas transmission takeaway from that area. So a lot of assets around that production area. And then also in the Haynesville. So that business is about 5% of our business. And then the balance is made up of our NGL services business and our gas marketing business. And a lot of companies segment that gas marketing is embedded within their operations. We kind of, for the benefit of our investors, understanding what is short-term nature in our business, and certainly the gas marketing business is more short-term nature versus those other big systems, both the transmission and the gathering and processing are very long-term contracted, and that business, for the most part, is fully contracted on the transmission systems. The life of those contracts generally established today is 20 years. And in the gathering business, that gathering business is generally for the life of lease, which, on average is probably around 30 years. So we tend to run those businesses in a very long-term basis, and we contract for the very long term on that business as well. All of our gas transmission systems are fully contracted, so we're out constantly when we do need to add capacity. That generally means we've got a capital project to add additional transmission capacity in that business. So very centered around the natural gas business. In fact, I think we're the most natural gas-centric business there is here in the U.S., and that is not by mistake. We've been in a lot of different businesses over the years, but we think we have huge competitive advantages in the natural gas infrastructure that we have here in the U.S.
That's great. We are seeing significant demand pull from gas utilities in conjunction with AI, broader electrification, demand from LNG facilities. You talked about the long-term nature of your assets. How strong do you think those forces will be for Williams over the next 10 plus years?
Yeah. Well, the good news about large-scale infrastructure that we operate is it kind of it doesn't sneak up on you super fast because it takes so long term to plan and contract for large-scale infrastructure. And so the LNG business, we are right in the thick of building out for the LNG business here in the U.S. There's about 11.7 BCF a day of new capacity, so almost a doubling of our existing capacity here in the U.S. that's underway right now, and then another over 13 BCF a day that is looking to be permitted and constructed on top of that. So very large build out on the LNG side. But what has really become here in the last year has really become evident to us is the amount of incremental load that's going on with the utilities that we serve, driven by a few things. One, of course, is converting from coal-fired generation to gas-fired generation. And along with that has come, as we've transitioned to renewables in a lot of these markets, the big utilities know that they have to have gas-fired generation to back up those intermittent power sources. And so that is driving a tremendous amount of increase in the markets that we serve right now for gas-fired generation. And the really good thing about the way we contract that transmission business is we really aren't sensitive to whether that power is intermittent or not, because basically the utilities have to buy for the full capacity of that generation capacity to be able to back it up in time. And so we basically sell that as capacity, and we don't really care how much volume moves. So in other words, we don't care how much renewable growth there is. And in fact, we continue to hit peak days in all of our systems year after year as we're continuing to see coal get backed out and renewables and gas filling that in. But in addition to that, and what's really become evident to us here recently is all of the load that is coming from data center loads, as well as a lot of electrification of loads that are going on in both our industrial markets, and even things like EVs are actually starting to drive a load for gas-fired generation in a lot of the markets that we serve as well. So it's really across the board. I've never seen a time like this. I've been with Williams for 38 years, been in the gas pipeline and gathering business for that length as well. And I've never seen a time like this where we've seen so much demand for our services piling up on us in so many areas. Things that you really would never even think about. A lot of businesses that used to be in Europe and that are fairly heavy energy users coming home, being industrialized here in the U.S. So a lot of reshoring of industry here. Obviously, fertilizer, anything that is natural gas based as a major source for its feedstock. The U.S. is the place to do that with its abundant resources, and even things like Trona, which is Green River, Wyoming, is actually the largest source in the world for Trona, which is a component used for bicarbonate glass. And of course, bicarbonate glass is used for solar panels. So huge demand building up in that space. Today, most of that energy that is used to mine that and heat that solution is done with coal. And of course, that is being rapidly converted over to gas today as well. So really just about anywhere you can name right now, it's all compounding to be a lot of incremental demand on all of our systems. It's not just Transco. We're seeing it on Northwest Pipeline now. We're seeing it on our Mountain West system that serves the Wyoming, Colorado, and Utah areas. Salt Lake City is actually a really big growth market for us right now. And our Gulf Stream system that serves Florida, we're seeing a lot of incremental load there. So it really is kind of across the board right now. Anywhere that permits can be obtained for expanding a pipeline is where we're seeing demand growth right now.
So let's talk about one of your newest assets under development, the Southeast Supply Enhancement Project. I understand it's one of the largest project that Williams has ever undertaken. Can you touch on the strategic importance of it, as well as the duration of the cash flows that you're expecting from that project? And if you could also touch a little bit about Transco and the future opportunities for investment that it provides, and really any other insights on the backlog of projects that you have.
Sure. Well, as what we call SSE, or the Southeast Supply Enhancement Project, is a project that's taking advantage of gas supplies that are coming in from the finally permitted and finally completed Mountain Valley Pipeline that comes out of the Appalachia. It's now owned by EQT, the big gas producer there in the Marcellus. And that ties into our Transco system in the Virginia area at Station 165. So an area that was really, really dying for new gas resources in that area, because they are trying to retire a lot of coal-fired generation in that area. And when we say that it's the largest project, it's certainly not the largest project in terms of miles of pipe or even capital dollars, but it by far is the largest project we've had from an earnings standpoint. And so let me put that in perspective. You heard me say earlier, Transco is the largest EBITDA, largest pipeline here in the U.S. and the largest EBITDA, and that's right at just under $2 billion of EBITDA for the Transco pipeline. The SESI project, if it was a pipeline by itself, would be the 10th largest project of the long-haul pipelines here in the U.S., and in fact would actually surpass our Northwest pipeline, which is the 10th largest pipeline here in the U.S. in terms of EBITDA. So it's really powerful from an EBITDA standpoint. It's about $1.5 billion of new capital that we'll be investing, but really impressive in terms of the return that we're making on that. A lot of people, that's confusing to people because they say, well, it's a regulated pipeline, so how do you make those kind of outsized returns in that business? And the truth is that it's gotten so hard to build pipelines here in the U.S., and our pipelines are all fully contracted, and therefore if somebody wants an expansion, the government or nobody else can force us to expand, and that's what gives us that market power to use what the FERC refers to as negotiated rates. And effectively it says, as long as you can go get those rates negotiated with your customers and bring them forward to show us what they are, you can move ahead with the project. And so, in fact, and now even today, even before that project, over 50% of our earnings now on Transco are under those negotiated rate cycles. So the returns in our business are coming up dramatically. That's driven by two things. One, all of the demand that is occurring very rapidly in the space right now, and the incumbent power that we have and the advantages that gives us from a permitting standpoint. So the kind of the inability today to build greenfield infrastructure, long-haul pipelines here in the U.S. puts a lot of value in systems that go through these very heavily populated areas like Transco that are almost impossible to build into today with new pipelines, and so gives the incumbents quite a bit of value in these markets today. And so we're certainly seeing that, and I would tell you that is going to become a very normal return for us against these businesses. We're seeing our ability to push through on pricing there very easily. So,
okay. So shifting to another growth driver for Williams, can you talk about the storage business as well? How much capacity there is market-based? And my understanding is that rates for storage have doubled in the past few years. And so, how long are your contracts? And do you expect a steady tailwind going forward with those rising rates as those old contracts renew at these higher rates?
Yeah, this is an area that Williams has been focusing on for about 3 years now. We started seeing that how low price storage was and how little had been invested in it. And that's kind of the way we think about it at Williams. We look for areas that are underinvested, and we don't look to what the current pricing is. We look to the things that'll drive pricing long term. And what we saw was, as we studied that the natural gas demand for the last 10 years had grown about 43% over the last 10 years. The transmission capacity to serve that demand had grown by about 27%, but the storage had only grown by 3% during that same time frame. So that was one, and one of the reasons for that was it had been as the new shale resources became available here in the U.S., people thought, well, we really won't need that much more storage because we'll just be able to draw on the abundant shale resources that we have. But what people, I think, didn't really plan on were a few things. One, as we become a larger exporter of LNG here in the U.S., we're going to move from 100% utilization to somewhere below that. And let's just say, for argument's sake, that's 90% I tend to believe it'll go a little bit lower than that, but whatever it is, it's going to come off of 100% as we get enough infrastructure built to satisfy the peaking demands for export out of the U.S., as opposed to today where there's a full-time margin and it's at 100%. When that occurs, there's going to be a big demand pushed on storage, because people are going to have somewhere to go with that gas that's already bought and flowing by the LNG exporters. The second thing that's really driving, and we're seeing this on our systems, is because we have underinvested in the transmission capacity relative to how fast the demand is growing, storage itself is even more in demand. And I know the distinction here between transmission and storage, but because these systems have gotten so tight, we used to be able to carry the load swings on our pipelines fairly easily. They were fairly predictable because they were based on long-term or more predictable weather trends. As renewables have entered the market, we don't know when the calls are going to be so hitting our pipelines as hard as they have. And so now we're actually getting down to where we're really having to manage our systems more on an hourly basis. And frankly, we just don't have the storage and the flexibility on our systems to be able to meet customers' demands. So that is rapidly driving up the value of storage here in the U.S. And as you said, since we started buying storage about 3 years ago, we've seen rates double during that period. So and I would tell you, I think we're still going to have incremental storage built out here in the U.S. because we are hearing from our customers all the time that they are going to be needing more and more flexibility on the transmission capacity that they're buying from us. So we've done 4 big projects. We bought the Nortec storage, which is a very large storage facility in the Dallas-Fort Worth area, and tends to carry a lot of the big swing loads there for LS Power, who's a merchant power provider in that area. And really, that's starting to carry a lot of the Texas market as it continues to swing with wind and LNG exports. Second, we bought the Hartree gas storage in the Gulf Coast area. That made us the largest storage owner in the Gulf Coast now by a pretty large margin. And then finally, we bought Clay Basin storage when we bought Mountain West, which is the critical storage for the western states. And we're in the process of expanding Clay Basin right now on a very low capital basis. And then the fourth thing we've done is we took our Washington storage, which was Transco's largest storage facility that was in its rate base, and we have went through the regulatory process to be able to go to negotiated rates on Washington storage as well. And so that is 4 really big moves from a Williams standpoint that we think has us extremely well positioned to carry this more volatile market that we're going to see in natural gas demand markets here in the U.S.
Thank you. Yeah, it sounds like it. Moving to capital allocation, can you talk about the balance between how you view dividend growth and stock buybacks? And then as it relates to the dividend, can you touch on the safety of it overall and your growth expectations of the dividend going forward?
Sure. Just to kind of give a little background there, when we bought in our MLP back in 2018, we came out and said we expected to be growing our EBITDA at about a 5 to 7% growth rate during that time frame. We were in the process of reducing debt and improving our balance sheet at that time. But even with that, we managed to grow our EBITDA actually without issuing any equity. So this is all on a per share basis. We were able to grow our EBITDA by 8% during that period, as well as our AFFO, or our cash flows from operations, without adjusting for working capital adjustments on an annual. So truly kind of the operating cash flows of the company. Both of those grew at that 8% mark. And on that, we grew our dividend on a compound annual growth rate. We've grown that at a 6% level against that. And we've maintained a coverage on that. In 2023, our coverage was about 2.39 times against that AFFO on our dividend. So very well covered dividend. And we would expect to continue to maintain that coverage. So tremendous amount of steady, predictable earnings growth that we've been able to deliver on the business, and that dividend, again, has grown at about 6% while we've actually been increasing our coverage during that time frame. So long haul, we continue to expect to be able to deliver on this 5 to 7% growth rate. It's very identifiable right now by a set of projects that we have through 2027. At the end of next year, we'll be doubling our deep water business through about 4 big projects that are coming on right now. And then on the tail end of that, a lot of transmission projects, and then into 27, the SESI, or the big Southeast Supply Enhancement projects, come on. So very clear to us where that growth is coming right now through 2027 that'll continue to drive that. But one of the really impressive things, if you're thinking about finance and cash flows and capital allocation, our return on invested capital on average over the last 3 years has been 19.5%. We actually think that is going to improve with the returns that we have coming on here over the next 2 or 3 years. We actually think that return on invested capital is actually going to lift for us. And as a result of that, we are going to have a lot of capital capacity because we have our balance sheet where we want it today, in between 3.5 and 4. Cash flows are really going to be coming in pretty hard. A lot of the big deep water investment, we've already completed that deep water investment, and so now we're just sitting here ready for the producers to bring that those fields on. That'll drive a lot of cash flow across our systems. And so really, capital allocation is a very big question, and it's in a very positive light because, frankly, we're going to have a lot more capacity than we've had in a long time. And so we are going to be having to make a big decision about, do we buy back more shares? Do we make bolt-on transactions that are attractive for us? Do we continue to invest in our rate base? So we have about $1.5 billion in emission reducing projects on our transmission systems, and so that's a place that we'll put capital as well. But the issue is growing for us pretty rapidly, where our free cash flows are really outpacing what is a great set of opportunities, but frankly, it's just growing. The free cash flows are growing so rapidly that we are going to have to make some decisions on either share buybacks or stepping up our dividend even faster than we have today.
Wow, that's great. Finally, what do you think today one of the biggest things that our investors are missing about the Williams story today?
Yeah, well, I would certainly say that, from the outside, a lot of what you hear is natural gas is going away, and we're going to come up with solutions that are no carbon solutions. And I would just tell you, we are doing a lot here at Williams to reduce emissions within our business. And so we have a goal out there in front that everybody's bonuses is tied to in terms of how much we reduce our methane emissions. We are on target now to be at 0.0375%, not 0.0375, but 0.0375% of our total operations by 29, and that's as part of being part of the OGMP, which is the Oil and Gas Methane Partnership, because we are very convinced that natural gas is one of the most powerful tools that we can use around the world if we can show that we can keep our methane emissions lower and lower, which we can and we are, that it is a very powerful tool for us to be able to reduce emissions versus a lot of the very heavy hydrocarbons and particularly coal that we're using around the world. And so we're excited about what we can contribute to methane emissions reductions and to greenhouse gas emissions writ large. And so we're excited about that. And at the same time, a lot of this political pressure and environmentalist pressure is actually driving our returns higher because we're trying to electrify everything. As we try to electrify everything, that just drives more and more peak demand against our gas pipeline systems. And so I would just say the opposition to our business is actually driving a tremendous amount of opportunity for those of us that I think are thinking about it from the long term and really focused on showing that we can be a part of a reduced emissions energy environment for the long haul, and that's very much what our company's focused on.
Well, thank you for that. This is great. Williams seems to really be in the crossroads of a lot of interesting things that are happening from an energy perspective, from a technology perspective. Where can people go if they wanted to find out more information about the Williams companies?
Well, sure. The obvious www.williams.com is a place to start for that. And a lot of information out there. Our new Energy Ventures group has a lot of information out there about what we're doing with things like next-gen gas, where we actually are using blockchain technology to track all the way from some of our biggest customers that are also proud of what they're doing from an emissions reduction, all the way from the point of production, all the way to point of consumption. We're using blockchain technology to track and put emissions attributes all along that value chain. People might think that gas just comes into one end of the pipeline and goes out on the other, and it's much more complex than that. And there's a lot of places for emissions along that need to be managed, and we do manage, and we measure that and attribute that to each MCF. So we actually have 4 pretty sizable packages of gas now here in the U.S. where we sell that gas as next-gen gas and certify it through KPMG actually does certification on that for us and does the auditing and provides a certificate to the end users about the emissions attributable to the gas that was produced and delivered to them. So that's a great thing to go look at, frankly. Really interesting technology. And the good news about stuff like that, I'll tell you that I probably didn't appreciate when we started into that, is it fires a lot of our employees up to show that they are leading the way on doing things that help the environment. And I can absolutely see the energy that we get back in our company from people working in a place that they know is trying to do things right.
Great. Well, thank you very much, Alan. I appreciate the time today. Thank you again, Glio, for this opportunity to highlight Williams. And thanks again, and hope to see you and speak soon.
Thank you.
Thanks, Frank, Alan, for those great insights. Before you leave us, I'd like to draw your attention to the next edition of the Glio webcast series, which features Cellnex and GIC. Finally, the latest edition of our journal is available online. And if you need any more information about membership of Glio, then please contact me at s.stevens@glio.org.